Hey everyone, welcome back to another episode of Stock Talk with David. I'm David, and in this one I just wanted to discuss Virgin Galactic. Is it going to the moon or not? Does it have the potential that people say it has? And so this is what we're going to be looking at in this episode. And so Virgin Galactic, they're sending high-paying customers to space. Right now, that's their main plan of revenue sources, ticket sales, and they've had quite a few come in. However, they're also looking to add the professional side, maybe outsource some of their products, some of things that they do to NASA and some other scientific research, right? So ticket costs $250,000 per ticket, so for pretty high net worth individuals. Right now, lots of R&D. I think right now the cash burn is close to $1 million a day, and they're backed by Sir Richard Branson and Virgin. So timeline, like I said, is to send the customers to space by 2030. Test flights were scheduled for February, but have been delayed until further notice. That came out in the earnings call a couple of weeks ago. And looking at some of the money, on the money side of this, cash is being burned with pretty much $0 in operating revenues. Yeah, they bring in the ticket sales and this and that, but it's not really enough to sustain them, right? So that's why they went public in the first place. They raised all that cash. And they're putting that to use with the R&D, right? Secondly, really interesting is that Richard Branson, CEOs, all the executive guys, right? They've sold close to all their equity in the company when the share price was pretty high, okay? And so that does not signal that much strength in the company to me personally, right? And then another thing is, we're looking at financing rounds here. Yeah, they got the money from the SPAC. They've got it from creditors and other investors. So they have enough money to keep burning for the next few years, right? That's not a big deal. But the thing that gives a company its intrinsic value is the cash flow. So if there's no cash flow to the company, it's essentially worthless, right? So that brings me to the next point, talking about catalyst. Starting with the negatives here. They are exposed to inflation, and you'll see this, in my opinion, mostly on the supply chain, whether it's in materials costs, commodities, like the jet fuel, aluminum, things like that. Exposed to interest rates as well, so cost of capital could cost more down the road when they're trying to bring on loans and other creditors. They're also reliant on certifications and safety holds from the regulating bodies and authorities, and any delay in that could set the stock price back even further. Failure of test flights and breakdown of parts. And so we have seen, I think in this last earnings call, they mentioned something about some parts not working or not getting them on time. However, positive catalysts, and these could have a big effect to the upside, right? Big name investors coming through. Okay, so when we're in SPACs, we're not necessarily always betting on the company, but the jockey. And so you see a lot of big names coming in. That can move it up for sure. And then secondly, the sudden advancement of timeline. Let's say that they have a test flight planned for December and it gets moved to August. Just an example. That could really cause the stock price to move, and it can maybe make the position go against you. So you have to be careful of that, okay? This is what I found to be most interesting, and it is the adjusted EBITDA, and really here looking at the net loss of the EBITDA. And so really all this is showing is what did they lose in, what money did they lose in. We're talking about earnings, right? And so you can see this quarter in 2020, the stock-based compensation, and again this is in thousands, 4,425, whereas this year it was 22,111. And so that is what we just talked about a few moments ago. That is all of the big guys inside the company that hold a lot of shares completely selling out and getting rid of it, okay? So that's going to bring the loss down for the company a lot, especially as the company, they have to cash out all that equity. And again, just not the biggest vote of confidence to me why they would even do that in the first place, right? Unless they weren't super confident in this thing happening. To speculate even further, it could just be that they're expecting a long time for it to even become profitable. So I find that interesting. Moving into just the outline, pretty obvious here that I'm not optimistic within the next 1 to 3 months. The cash burn is nearly $1 million per day with $0 in revenue coming in. Now that could change as they start to have some processes in place that allow them to generate revenue, maybe more on the professional side, outsourcing, things like that. And again, they are subject to delays and price increases. And so I would trade it on the 1 to 3 month timeline. This is how we've talked about it in our group. Ideally, puts, I wouldn't want to tie up a lot of capital in this. The stock could fall below $10 if rates get an unexpected move up, like a pretty quick rate up. You'll really start to see this thing become exposed to the interest rate risk there. And so you can grab the $17 puts or $18 puts expiring in June, anywhere for 215, or if you're maybe a little more bearish on this, you could even grab them for about 1.6. So that's what I would look at. Just make sure you're getting a good deal on the puts. Don't pay too much in premium relative to what it's worth. So keep an eye on that. And that's it, guys. Thanks a lot for listening. We're talking more about this in our group, so if you're into that, definitely check it out with the comments below. Let me know what you think. Any comments or questions, or even some insight too. I'd love to hear it in the comments. Thanks a lot.